our Introduction to Managerial Accounting. And in this video, we're going to start with a brief review of your financial accounting course. And then we're going to discuss the significant differences in financial and managerial accounting. So to start with, we're going to look at a quick review from your financial accounting course. Specifically, we're going to talk about the accounting equation. So this is something you definitely should remember. The accounting equation is, of course, the foundation of financial accounting. And the accounting equation is assets equals your liabilities plus your owner's equity. And so we want to be able to define each part of our accounting equation. We define assets as economic resources or future economic benefits. So some examples of assets would be cash, accounts receivable, equipment, land, notes receivables. Some students think about the definition here and they think about cash and they think, well, how is cash a future economic benefit when I have the cash in my hand right now? Well, having cash in hand really isn't a benefit until you actually use it to accomplish something. For example, paying a utility bill or buying a piece of equipment. Then it becomes a future economic benefit. Liabilities. These are your creditor's claims on your assets, more commonly referred to as your debt. So these would be things like wages payable, accounts payable, notes payable. Those have something in common. It's the word payable. So anytime you hear the word payable or see the word payable, that account is a liability. And then we have owner's equity. Owner's equity is your owner's claims on your assets. This would be common stock or retained earnings, preferred stock. So now let's look at some examples of some principles. The principles that you learned in financial accounting you really have to carry with you throughout your accounting career. So we're just going to talk about two of the main ones, one of those being the matching principle. So you recall the matching principle, it stated that we record expenses when expenses are incurred, not necessarily when cash is paid. And I say necessarily because you can incur an expense and pay it at the same time. But either way, you need to record that expense when it is incurred. That way, we're matching the expenses with the revenues those expenses created. So you've heard the old saying, you have to spend money to make money. So we just want to match those up. So let's look at an example here. Let's say we pay wages on the 15th of the month, and a month's worth of wages is $10,000. So from the first of the month to the end of the month is $10,000 worth of wages. And we pay on the 15th. What is the journal entry required on December 31st? So this also goes back to your adjusting entries. So you have to remember how to make adjusting entries. So what's happened here on the 16th of December through the 31st of December is we have incurred a half of a month's expenses that we need to record before moving on to the next period. So to do that, we would debit our wages expense and credit our wages payable. But we're only recording a half of a month. So it would be for $5,000 because a full month is $10,000. But we're only expensing the 16th through the 31st of December. Now let's look at the other side of that. Well, what happens on January the 15th? Because on January the 15th, we're actually going to pay a full month's salary, or wages in this case. So from December the 16th through January the 15th, we're going to pay this $10,000 in wages. So obviously we're going to credit cash for $10,000. But what do we debit? Well, we've incurred another 1/2 month's wages expense. So we're going to debit wages expense once again for $5,000. Well, we don't balance. But if you look at our original entry, we credited wages payable for $5,000, meaning we owe wages payable of $5,000. But now we're paying all that off, so we no longer owe it. So we would also debit wages payable for $5,000, thereby making our journal entry balance. Another principle I want you to recall is the revenue recognition principle. Remember, the revenue recognition principle requires that you record revenues when revenues are earned, not necessarily when cash is received. So, for example, the Widget Corporation sold 5,000 units of the triple widget on account. So recall what that means, on account. That means we're not receiving cash right away. We'll get paid later. So we need to journalize an account receivable, not cash. Each unit cost widget $2.50 each, and it is sold for $6 each. Journalize the sale and the cost of goods sold for this transaction. So please remember, when you make a sale, there are two entries. One entry is to record the sale. The other entry is to reduce the amount of your inventory and record the cost. So the first entry we would make is to record the sale. Remember, it said we sold it on account, so we would debit our accounts receivable for the amount of the sale, which was $30,000. We sold 5,000 units at $6 a piece. That's $30,000. We also earned revenue. Even though we didn't get the cash yet, we earned it. And the revenue recognition principle states we record revenues when they are earned. So we would credit sales revenue for the $30,000. But in addition to that, we have to reduce our inventory and record the cost of that inventory that we sold. Again, matching the expense with the revenue that expense created. So referring back to the matching principle as well. So the cost was $2.50 each, times 5,000 is $12,500. So we would debit our expense, in this case is cost of goods sold, for $12,500, and we would reduce or credit our inventory for $12,500. Also, you should recall a form of the income statement that you discussed in financial accounting called the gross profit income statement. So in this case, we can calculate our gross profit at this point. Remember that gross profit is sales less cost of goods sold equals gross profit. So in this case, it would be $30,000 less $12,500 would give us gross profit of $17,500. So the last thing we want to talk about in part 1 of this series is financial versus managerial. So what's the difference in the two? So financial accounting provides financial statement data to external users for use in making informed decisions about a company. So for example, I as an investor, I may go look at your financial statements and decide whether I want to invest in your company or buy stock in your company. If I'm a banker and you come to me wanting to borrow money, I may look at these financial statements to see if you're a going concern, whether you're going to be in business for the long term and you're going to be able to pay me back my money. Managerial accounting provides financial data to internal users for use in making decisions for a company. For example, the managers, they would require certain amounts of information, certain types of information to make decisions for a company. What direction do we want to go from here? So now we want to look at the users. So we talked about a little bit of them here a second ago. Financial accounting users would be creditors. That would be your bankers, people lending you money. The IRS, the government, and potential investors or current investors. And managerial accounting would be used by managers, again, to make decisions for a company.